Hi, I'm Mike, Chief Investment Officer here at Lighthouse Financial, with another edition of our monthly market update. So let's get started. Here are our talking points. We're going to size up the rally, stock and bond market rally. Stock market looks like it's been, especially since April, been dominated by tech and internet, which means AI. And yet, I think we're starting to see signs of a broadening out. In other words, a rally that sort of floats all boats. And we hope that that can continue. The whole thing is driven by corporate profits, which are improving steadily. And I'll show you what I mean. But it looks pretty durable. We have to talk about the rate debate again, because the Federal Reserve has pivoted, and that is they've changed their messaging a little bit. And it looks like we are going to get rate cuts before the end of the year. The Fed is now equating the risk of reigniting inflation with the risk of damaging the job market. They think those risks are now balanced, which means that we are probably set for some looser monetary policy. Investors want it now, and I'll show you why. And finally, we'll chart the economic landing. You know, the Fed is trying to engineer what they call a soft landing. In other words, they are trying to get us past the pandemic-related distortions to the entire financial system and tamp down that massive inflation that we saw in 2022 with higher interest rates. And the idea is to tamp down that inflation, but not get too draconian with the interest rate hikes that might cause damage to the economy. Nonetheless, we are seeing the economy slow down, and I would call it more of a normalizing process rather than a slowdown, but I'll show you why I say that in a moment. So let's get back into the stock and bond market rallies. This chart you've seen before, goes all the way back to late 2019. And boy, a lot of volatility here, 2 bear markets and 2 bull markets. Stock market is seesawing, but it is seesawing higher. And it does look like that October 2022 bottom was durable. And this is the new business cycle. It's also the new bull market. And we believe it's durable. You can see that we've already surpassed the previous highs from early 2022 and just made fresh highs again. However, the gains have been lopsided, and I want to refer specifically to the S&P 500. There are a lot of different indexes you can use to gauge how the stock market is doing. A lot of our clients use the S&P 500, but it's a little misleading. You can see there at the top left, these are returns for just the first half of 2024. The way that the S&P 500 is typically calculated is market cap weighted. And that means that the biggest companies in that index are going to have the greatest weight, and they're going to end up driving the returns, whether positive or negative. Well, you can see that the number is plus 15.2%. And that's really good for a 6-month period. Typically, looking back at the past, you get 10% a year. But look at the S&P 500. If you were to equal weight it down below there, equal weighting means that all the 507 companies, or however many there are weighted exactly the same. You would have a 5.1% return for the first 6 months of this year, and you could drive a truck through that divergence. It is massive. Just for comparison, I put the Dow Jones Industrial Average return at 4.8%. I think what this points to is a rather lopsided gains for the index. And if you follow that red arrow to the right, what this chart shows you, and it's provided by RBC Wealth Management, what this chart shows you is that about 33% of the S&P 500's return, total return, was driven by one stock, NVIDIA, just one stock. And the next 7 biggest stocks, which include Microsoft, Alphabet, Meta, Amazon, Broadcom, Apple, Eli Lilly, those next 7 stocks account for another 38% of the index return. So So really 71% of that 15% gain is just 8 stocks. And that's not normal. This is a very abnormal situation. It's probably not sustainable. That's why we believe a broadening out, a catch-up trade, if you will, by the other roughly 490 stocks in the S&P 500 is probably due and probably coming. And over the last couple of days, we have seen evidence of that. Now, one of the reasons that the stock market continues to move higher is not just AI hype or speculative investors entering the market. It's an earnings tailwind. In other words, corporate profits, which really were kind of down in the dumps in 2022, have begun to rebound in a big way. Now, this chart shows consensus earnings estimates for the S&P 500 companies, all 500 of them together, and it's for a forward 12-month period. In other words, this is what analysts on Wall Street expect over the next 12 months. And you can see that so far this year, that line is moving pretty steadily higher. And what that tells me is that profit margins are increasing. Companies are pretty effectively managing the financials to make sure that they remain profitable and that they're growing those profits. And that is a recipe for a continued or a durable rally. Let's get into some of the individual companies that have reported earnings recently. Now, we are at the cusp of the second quarter earnings season where all public companies have to report their results for the prior quarter and then also usually give some kind of guidance as to what they think is going to happen this quarter or for the balance of the year. So let's get into this. Pepsi, they reported weaker sales growth and it was a disappointment. The CEO said that, however, it's an issue of value and not an issue of anything else. Well, what does that mean? It means that they raised prices so much coming out of the pandemic that consumers are starting to really balk. The quality of their products isn't getting any better, but the price keeps going up, and at some point you get a revolt, and consumers shift away from that company's products to products that they feel provide better value. Now, you can see that same trend with the McDonald's earnings report that came out previous. Same thing, weaker same-store sales. And the idea was that their products just aren't good value anymore. And you can interpret that one of two ways. The news media typically says, well, McDonald's and Pepsi reported slower sales growth, and that means consumers are strapped and they're running out of money. Okay, you can say that. Or you can say, no, consumers have had it. These products that these companies are putting out there just don't represent a good value. So it's not that consumers are strapped, it's that they are seeking value elsewhere. And that's what I believe the truth is. You can see on the right-hand side of this slide, by the way, the stock chart, and Pepsi stock chart has been pretty poor lately. This is part and parcel of just the daily and weekly and monthly flow of buys and sells and investors, by the way, expressing their views about the value of the stock. So there's consumers expressing their views on the value of the company's products. And I'm showing you a little bit, giving you a window into here about how investors start to think about value in the stock market. Delta is next. They reported what they believe is record demand through the summer months for travel, and it's not just leisure, it's also business travel is doing well, international travel really coming back. But they said industry-wide overcapacity is causing ticket prices to fall. So there's a little bit of a price war in terms of airfare right now, and that's self-inflicted. So demand is fine, but the way the industry has managed itself, capacity growth is outstripping demand growth. And so if you're growing the number of seat miles that your airline is flying by 6% a year, but demand is only growing by 4%, well, you're going to find yourself with lower prices as a result. So that's what we see with the airlines. They've done really well for the first few months of the year, and now selling off a little bit to deal with this overcapacity. Again, this is not a demand issue. You can say, well, you can interpret this a couple of different ways. Well, consumers are cash strapped and they can't pay the high ticket prices that we had. Or you can say, well, this is because of overcapacity, and that's really closer to the truth. Next, Carnival Cruise. If you were going to see real weakness in the U.S. consumer, you'd probably see it here. They are reporting record new trip bookings, and the CEO said, I keep getting asked this question, are consumers in trouble? And he says, well, no, if anything, we're seeing acceleration. And they're seeing strong momentum on both sides of the Atlantic. You can see that this stock market, this stock chart was in trouble for the first few months of the year and is now recovering nicely. Finally, on this slide, Micron, and I put this in here, they reported earnings recently, put this in here because they are part of the AI contingent in the stock market, these companies that are really benefiting from a boom in AI investment. And they said they're seeing robust AI-driven demand for all of their data center products, memory chips, that is. And it's their belief that the industry will not, in the near term, be able to supply all the chips that are being demanded. So not surprisingly, you see this stock chart has been very, very strong recently. But I want to say a word about relative value. Whereas Carnival probably represented some relative value a couple of months ago, in that the stock price was pretty low and operations were getting better, operating results were getting better. It's possible that Micron and some of these other AI-driven stocks have seen such good results that their stock prices have come so high that they might need to consolidate or retrench or correct a little bit. And so you see that at the tail end of this Micron chart. Two more I'll cover. First, JP Morgan, and this bank reported earnings today. Revenue growth was 20% year over year. That's pretty good. And the reason, well, they saw a strong recovery in investment banking and trading. So what that means is capital markets are booming right now. You're seeing more IPOs, you're seeing more stock and bond offerings, and deals being done, and also obviously bond and stock trading has been pretty profitable. On the traditional banking side, however, I think optimism was a little tempered. Deposits and loans growth, it's nothing stellar. It's okay. But they did add to their loan loss reserves. So banks have to look forward and judge what they think is going to happen with credit quality down the road. And in this case, they're adding to their loan loss reserves, thinking that perhaps more loans down the road are going to go sour. That usually is a sort of a negative sign. In this case, nothing's black and white. Everything exists in gray in my world. In this case, yes, they did add to loan loss reserves, but it wasn't a massive amount. So I think they're probably being prudent. And then finally, Fastenal. Second quarter results were just okay, really. And I lifted this sentence from a Bloomberg article. 2Q results were broadly in line with consensus. They didn't beat. A relatively encouraging sign here, giving a challenging economic backdrop, and they're likely to alleviate concerns over a more severe downturn. So in any market, you're going to have industries that are doing well, industries that are not. Okay, so we know AI-driven stocks have done very well, and their sales growth, their profit growth has been very strong. The manufacturing sector has been very challenged in this country, and for over a year. And I think the stock chart at the right here tells the whole story. Just a real erosion of investor confidence because sales growth, profit growth has not been strong. But you see a hookup at the very end. I think we are beginning to see a turn in manufacturing. And this kind of feeds into my theory that we're going to see a broadening of this rally beyond just tech and internet to manufacturing and materials and probably healthcare and financials, which is really what we need if we're going to keep this rally going. We need it to be broad. Just change channels here real quick to the bond market. Bond market's had a tough time. You know, the rally hasn't been near as strong as it has been in the stock market, but I believe that we've seen a bottom in late 2023, and it looks like bonds, I think, can rally a little bit here. This chart is a chart of a really widely held fund called the iShares Core U.S. Aggregate Bond Fund, and it's pretty broad-based. It holds municipal bonds, asset-backed bonds, and corporate high-grade and junk bonds. And I want you to see that it's had a major valuation reset. This thing has come down a lot. And at the end of 2021, the interest yield that you would get as an investor buying this fund was only 1.8%. And now it's 3.4%, much better, right? So I think bonds provide much better relative valuation than they used to. And interestingly enough, Goldman Sachs put out a report to its clients the other day, urging them to be done with cash instruments, saying, hey, those of you who have been hiding out in money market funds or CDs or short-term treasury bills, now is the time to get out of those and to move into the riskier sides of the bond market, or at least get into the longer duration, like longer term bonds. And so they're starting to see the same thing we are, which is that bond market probably has bottomed, and it's probably time to move out of those short-term instruments. Okay, interest rates are really, really, really crucial in driving stock market and bond market. And I wanted to revisit this chart that you see from time to time. The orange line is the federal funds interest rate. The Federal Reserve gets to set this independently. And that's why you see it stair step up on the left-hand side of this chart as they're trying to fight inflation. And that's one of their tools. They try to tamp down inflation with higher interest rates. Okay, so the blue line is different. The blue line is not driven by the Fed. The blue line is independent investors buying or selling short-term U.S. Treasury notes. And I want you to notice that they sort of stair step up together on the left-hand side of this chart, but then they depart. The Fed has held interest rates steady at a high level for about the last year, almost the last year, whereas the blue line, or sort of investors investing in the short-term bonds, have been guessing at when do they begin cutting rates. And there was a little bit of a head fake a couple of times where the blue line comes down. That is, you know, yields start to come down because they think, okay, Fed's they're gonna cut, and they don't. I think we are now, though, at a critical juncture where the bond market's getting it right. In other words, that at the end of this blue line, you see interest rates start to come down. I think the Fed's going to start lowering their rates, and I'll tell you why. The first reason is inflation. This is just a chart showing 4 different measures of inflation, and you can see that they peaked out in mid-2022 and have been steadily moving lower. And yeah, there was a little bit of a head fake in the first quarter of 2024 when inflation ticked up a little bit, but this chart's pretty clear, right? That the path is lower. And we got another report yesterday confirming that that is the case. Inflation is heading lower, and I think the Fed and investors are getting more confidence that that's the case. And the risk of reigniting inflation, I think, is getting lower and lower. So this is reason number one. And here's the Fed's acknowledgement of that. Jerome Powell, of course, is the chair of the Board of Governors of the Federal Reserve System. And earlier in the week, he said, the economy is no longer overheated. The job market is fully back into balance where it was before the pandemic. And the likely direction of interest rates is that we begin to loosen policy at the right moment. Okay, so two operative terms here. Loosen policy, that means cut interest rates, and at the right moment. He is trying to pick the moment. He's trying to time this. And that makes investors a little bit uneasy. Now, the Fed, I think, has done a great job so far in guiding us through this multi-year period of trying to move past all these pandemic-related distortions in the financial system and get back to normal. But, you know, when is that right moment? When do they start lowering interest rates? I just showed you the chart on inflation. There it is coming back down, and you see that dashed purple line. Well, that's the Fed's target. We're getting pretty close to that target level, which is, by the way, about normal. You can see at the left-hand side of the chart, 2019 before the pandemic. So we're getting there. We're pretty close. And he's trying to pick his right moment. Meanwhile, reason number two why I think they're going to start cutting rates soon, the job market is clearly normalizing. And the Federal Reserve has two mandates, just two mandates. One is price stability. In other words, don't let inflation get out of hand. Two is full employment. These are supposed to be its two mandates. So they're looking at the job market, and they're probably seeing what the rest of us are seeing, and that is on the top, the total number of people that are collecting unemployment insurance has started to tick higher. Now, is this an alarm? No, but it started to tick higher. And at the bottom chart, you see monthly change in payrolls. And what this means is the net number of new jobs that this economy is generating every month is starting to fall. So fewer and fewer jobs, still in the healthy range, but fewer and fewer jobs. And I think, you know, anecdotally, we all sort of understand that the job market isn't quite as tight as it was before. So that's reason number two. Reason number three is that the economy is beginning to slow. Now, I showed you a chart the last time we met, and that chart basically said that economists keep guessing at an economic slowdown that never shows up. And they keep having to revise their estimates higher. Okay, so now we're at a point where it does look like the economy is slowing. Whereas economic growth was what they call above trend or above normal in 2023. Here in 2024, it looks like we are slowing back to normal, roughly 2% a year. And this chart is compiled by Citigroup. It just measures the degree to which economic data are coming in either better than expected or worse than expected. And I'll just point out that over the last few months, we went from a value on this chart of plus 50 to negative 50 roughly, meaning that data are now coming in worse than expected. So is this an alarm? No, not yet, but it is concerning. And here's why. The longer the Federal Reserve keeps interest rates at a pretty high or restrictive level, the greater risk there is of creating some kind of financial system problem. And so that's one of the reasons we're really looking forward to the Fed signaling that it's time to begin lowering rates back to what they would consider maybe a neutral interest rate, where you're neither hindering the economy nor really goosing it. And I think that time is upon us. And this chart is third reason why I believe that. So let's take a look at this landing, this economic landing that the Federal Reserve is trying to chart. Back in 2022, when interest rates were rising rapidly and inflation was a real problem, I think most investors and economists felt like we're in for a hard landing. And understandably so. In the past, when the Fed tries to bring the economy back from what it considers like an overheated position, it usually goes too far with interest rates and ends up knocking us into a recession. So that is typical, and that's why everyone expected a hard landing. But as we move forward from 2022 to early 2024, you know, it seemed like, well, there's no hard landing yet. So maybe it's a bumpy landing with just a lot of volatility in the stock market and the economy. But then it became sort of a, well, this is maybe a soft landing because we still haven't seen much economic pain, and financial markets are doing real well. And at the very beginning of 2024, investors started to wonder, well, maybe there's no landing at all. Maybe growth is so strong and inflation is so persistent that the Fed will just have to keep interest rates where we are now, and maybe that's okay for a while. But I think, you know, the charts that I've shown you pretty conclusively state that the economy is softening, inflation is in a landing pattern here, and it looks like we're back to a soft landing. And that is the consensus on Wall Street right now. That fits with what we believe. Not that we can't see a correction. I think that would be healthy. But at the moment, what we expect is a more or less durable bull market and a continuation of the rally. And I know it's hard to see with the stock market up, the S&P 500 up 15% during the first 6 months of the year. It's hard to see how we get much better than that by the end of the year. Maybe it's not better than that, but maybe we get a broadening out of the rally. Maybe the Dow improves. Maybe the S&P 500 equal weight improves. And a broader rally is, after all, more healthy for most investors, and for when you look at extending the rally for multi-year period. I want to thank you very much for watching, and we'll be back in about a month with another update. Thank you.